All right, part 2, statement of cash flows. All right, before we start looking at this, and we're going to be preparing the statement of cash flows here, I want you to think about the income statement for a second. What we normally see in the income statement is revenues minus expenses, right? Hang on, we're not ready to have that conversation yet. Okay, revenues minus expenses plus minus any gains and losses gives you net income, right? I'd like this to be underlined, but I don't think it's going to let me. Oh, maybe I'll draw it. Can't not have this be underlined. All right, revenues minus expenses plus minus any gain or losses, and it gives you net income, right? That's what you're used to seeing. Now here's the thing. We are going to start the statement of cash flows with net income. We're doing the indirect method. Okay, there's 2 ways you can prepare the statement of cash flows. We're going with the indirect method because that is the most common, the most popular. If you want to learn the direct method, by all means, but I'm not going to be covering it. All right, so we're going to use the most popular one. All right, think about what's in here. We're trying to get back to this. We're starting with net income. And then from there, we're going to add and subtract a whole bunch of different components. You have all your revenues, everything you earned, minus all of your expenses, and you have gains and losses. All right, in that expenses section, we actually have a pretty major expense, area of expense, if you will, that really doesn't have anything to do with cash, and that's depreciation, right? Depreciation is a non-cash event, right? Depreciation just shows basically the using up of an asset. You know, you're spreading the expense of using an asset over time. So like a desk, for example, right? You have a $1,000 desk, you're going to use it for 10 years. That's $100 a year if you're doing straight line depreciation. But there's no cash involved, right? There's no cash in showing depreciation. So if that's the case, and I'm trying to get back to a cash picture, what I'm going to do is I'm actually going to add back depreciation and amortization when we start this whole thing. So that should really be a plus sign there. We're going to add back any sort of depreciation. Same thing with amortization as a non-cash thing, and we're going to add those back. Okay, so they would be expenses or income statement, right? Depreciation expense, we're going to add it back. The other thing is going to be gains and losses, and I'm going to talk about that in a bit. All right, I think of an example would be better off there. All right, so we're going to move on down. Now I kind of gave you guys somewhat of a cheat sheet also. All right, I gave you that one that showed you what belongs in each section, but this is a good template for you on how to prepare the statement of cash flows. We start off with net income, as I said, when it's the operating activity section. And you start off with the company name, the statement you're looking at, and for the period ended or the year ended, 12/31, whatever, if you're in a calendar year company. So you start off with that operating activity section. You start, the very first item is going to be net income. And then we have a subsection. It's called Adjustments to Reconcile Net Income to Net Cash Flow from Operating Activities. And yes, it really is that long. And the first thing you're going to do is you're going to add back depreciation and amortization right here, like I said, because they're non-cash items. Now the gain or loss piece of it, I want you to think about this. If we're selling, where does a gain or loss even come from? If you're selling like a building or a piece of equipment or something like that, it's probably going to generate a gain or a loss, and that goes on the income statement, on this, yes, at the bottom of the income statement. But that's not part of your normal activities, right? When you're selling a piece of equipment, that's not, you know, unless you're in the business of selling equipment, you're not normally selling business equipment, you're just doing your job. Or maybe you're selling a building, what is something that you're not using. You'd have a gain or a loss. That doesn't really belong there. We talked about before this. Selling a building or something like that belongs in the investing activities section. So we're going to do 2 things. If we have gains, we're going to subtract them. Because what we're doing is we're backing them out of this section, right? A gain would have been an add to get to net income. If I went back here for a second, that gain would have been an addition to the income statement, and a loss would have been a subtraction. If I'm trying to get back to a true cash picture, I have to do the opposite. All right, I have to back them out. So I'll subtract any gains and add any losses. All right. Okay, this changes, that's it for that section, that part of it, of the operating section. The other piece of it is changes in current operating assets and liabilities. This is your day-to-day accounts, your main operating asset and liability accounts. And I'll get into an explanation of them as we're doing them. All right, but I've got just a couple of examples for you in here. That total is going to be the net cash flow from operating activities. Hopefully it's a positive number because it means you've made money doing whatever it is that you do in your business. From there, you've got the cash flows from investing activities. And like I said, investing is your own buildings, your own stuff, your investments, right? You're buying, you're selling. So again, we're looking at this in terms of cash inflow and outflows. Cash from sale of land, that would be cash inflow. Cash would come to you, so it's a positive. If you're buying a building, that's cash outflow. It's a negative, right? And it's not a bad thing to have a negative here, net cash flows from investing activities, because it means that you're investing in yourself. You've got cash going out because you're investing. Okay, so don't look at negatives and positives like they're good or bad. And cash flows from financing activities. If you're selling your own stock, then cash is coming in. So it's a positive, a cash inflow. If you're paying out dividends, that's cash outflow. That's going to be a negative. All right, and you'll have a total for cash flows from financing activities. So you add the three categories together, and you have the overall increase or decrease in cash from there. All right. Now I'm going to teach you a cheat, but we're not really ready for that cheat yet. Okay, let's get into the problem a little bit before we start getting into cheats. Okay. The first problem we're going to look at is right here. All right, so, okay, cash flows from operating activities, indirect method. So we start off with net income. What we have to do in this one is we're going to prepare an operating activity section. All right, so we start off with net income, as you saw. The net income reported on the income statement for the current year was $185,000. That is going to be the first number I grab, 185. Depreciation recorded on the equipment and a building amounted to $96,000 for a year. We need that number too, because we know we need to add back depreciation. So we're going to grab that guy too, if it lets me. There we go. And then we've got changes to current operating assets and liabilities. Well, let's start getting the statement going before I get into that piece of it. Okay, so we're going to start off with that net income number here of $185,000, which was from here. But then we're going to add back the non-cash items, which is depreciation in this case. It could have been amortization as well. They only told us about depreciation. So if that's the case, you have adjustments to reconcile net income to net cash flows from operating activities. All right, and there's your depreciation. We're adding it back. Now if we get any gains or losses, which we don't have in this problem, that would also be there. Now our next section is the changes. Oops, too far. Changes in current operating assets and liabilities. All right, so now is when we start talking about this. We've got cash, AR, inventory, prepaids, accounts payable, salaries payable. Now one thing, we're not looking at cash at all, because cash is really, everything that we're doing is a reconciliation of that cash number. So we're not looking at cash individually, but we are looking at all of the rest of these, and we're looking at the change from one year to the next. All right, so for example, let me kind of see if I can do this here. All right, from the beginning of the year to the end of the year, cash actually, it's gonna let me type on it, okay. Accounts receivable decreased, and that's a current operating asset and liability, right? Accounts receivable went from $90,000 to $84,550. So it decreased, and I would normally do a down arrow, but I don't really have the ability to draw arrows so well. Decreased by $5,450. Okay. Now here's what I want you to think about with that. If accounts receivable decreased, how does accounts receivable decrease? Accounts receivable decreases because people pay you, right? Accounts receivable is the money that people owe to us, and when they pay us, then the receivables balance goes down. So if you think about it, a decrease to accounts receivable means an increase to your cash. So if that's the case, what we're going to do is we will show a decrease in accounts receivable to be an add, all right, a cash inflow. All right, let's look at the next one. Inventories. All right, inventory went from, beginning of the year to the end of the year, went up. It went up by what, $11,200? So we've got an increase of $11,200. Okay, so now inventories. How did inventory go up? Inventory went up because we had to buy more inventory. So if you're increased to your inventory, what does that happen to your cash? It means you have a decrease to your cash. Okay, like I said, this is thinking about it in the most simple terms. I get that you could have owed the money, things like that, but just bear with me. All right, so if that's the case, an increased inventory would be an outflow of cash. And sorry, this keeps popping up down here. All right, prepaid expenses. So think of this like supplies, right? Supplies went from $4,500 to $3,600. So supplies went down So you have a decrease of, I'm going to cheat the number, $900. If you have a decrease to $900, it means that your supplies went down, but you didn't buy more supplies, so you kind of held on to your cash if you want to think about it like that. Sometimes these are this thinking process is a little bit fuzzy, but it's basically what we're saying here. Oops, it's not letting me grab it. All right, let me turn that off. There we go. So a decrease in a prepaid would be, meaning you're keeping your cash. Now, I don't have these memorized at all. I just think through the steps of, what happens if this goes up or goes down. Does that mean I have an increase or decrease to my cash? All right, accounts payable. Accounts payable went from the beginning of the year 110 down to 91.5. How does your accounts payable decrease? Right? It is a decrease of 18,500. Accounts payable are your bills. The only way your bills go down is if you pay them. So that would be a decrease to your cash. A decrease to 18,500 in accounts payable, meaning it went down, would also be a decrease to your cash. It's not going to let me do that. Let's turn that off. Okay, so a decrease in payables would be a decrease to your cash. Last one, salaries payable. Your salaries payable went from 4,000 to 7,200. Hey, it means you're not paying your people, right? But it's an increase of, increase of $3,200. Sorry, that's showing up there. Oops, too many zeros. Increase of $3,200. You know what? You're not paying your people, but you kind of are holding onto your cash. So if that's the case and you have an increase of $3,200, then you are going to have an increase to your salaries an increase to your cash here. So you add up all these changes in current operating assets and liabilities, and you'd add up your starting net income plus the adjustments for depreciation, plus minus all of these guys, and you'd wind up with net cash flows from operating activities of $260,850. Now you might think, wow, it's a lot to be thinking about all those things, right? Well, yes, but luckily enough, you've taken my class, and I'm going to show you kind of a cheat. All right, so now we're going to go back a page here. Oop, too far. Oh yeah, no, we're okay. And I'm going to show you the cheat. So hold on just a second. Okay, so here's your cheat. I'm sorry the L got cut off in liabilities in my picture. If assets from the beginning to the end, right? So if the assets go up, it's going to be a decrease to your cash. If assets go down, it's going to be an increase to your cash. Liabilities go down, it's a decrease to your cash. Liabilities go up, it's an increase to your cash. Okay, so you can look back at what I just did and see that this then applies. Okay, so that's your cheat. All right. Just one more thing I just want to hit you with now before I come off this page is non-cash activities. I just want you to be aware that that is a thing, and I have a slide at the end on that. The idea is that you could have non-cash activities, and to the extent that you do have them, you do need to, oh, it got cut off. No, it's okay. You have to report them on a separate schedule. Let's say you decide you're going to buy a piece of land and you don't have any cash, so you're going to offer somebody stock, or you're going to trade somebody one land for another land, or however it works out. If cash isn't involved, but it's a significant transaction, you have to report non-cash activities on a separate schedule. All right, I'll be right back. I'm going to go to video 3.